Okay. Well, thank you very much. Welcome back. This is week 7 of It's Your Money. I am Trevor Murphy, your host. We have Peter Kote moderating, and we have the prestigious Scott Anderson doing the presentation on fixed income investing, or bonds, more commonly, the vernacular there. We are still waiting on a charitable sponsor, and I may interrupt the proceedings if that comes on. But until then, Pete, why don't we start with the Ask First form and introduce Scott?
All right. Well, Scott has the illustrious job of doing one of the most difficult sessions in the 8-week series, because bonds and fixed income is the most complicated and also most non-transparent. And we'll talk more about that as we go through. Scott's got a chemical engineering. By the way, what I find, Scott, is people who have an engineering background make some of the best financial advisors. And I think because you all have to do that, your mind is trained to do it systematically and not allow the behaviors of the world to get in the way of what's really important. That's just my observation. You have a master's degree in business and oceanography. You've been doing this for 30 years. How long have you been in the actual business of financial planning? And talk to us just a little bit about that.
I got my certified financial planning certification in 2004. Shortly thereafter, because of my background in accounting and finance, I got my enrolled agent, which is my registration to practice before the IRS. And then the following year, I got my CPA. So I had been a controller and a vice president of finance of a number of companies, including 2 small companies, public companies. And I didn't have a CPA. So I got mine at the end of my business career. And it was very interesting when people tell me, my students tell me, oh, I can't do that. And I tell them I got my CPA exam. I passed the CPA exam at age 62. They go, oh, maybe I need to rethink this.
Yes, I think they do. Today, you are a financial advisor. That's your sole practice, I'm assuming. And besides being an instructor or a professor at Chapman University.
That's correct. I actually have 4 businesses. I do tax preparation. I do investment management, as you've alluded to. I teach at Chapman. I teach the beginning accounting courses, which means I deal with freshmen and sophomores. And the best thing I can tell you about that is a parallel universe. And I also work for my daughter, Julie, who alternates with me in making this presentation at various times.
And what does Julie do?
She is a financial planner and investment management. She has over $100 million under management, a firm that she actually acquired about 6 years ago. She is the president of it and responsible for it. I just go along for the ride and occasionally throw in my 2 cents. Nominally, I'm vice president for taxes, but that means she calls me up and asks me tax questions for her clients.
Okay. If somebody wants to use you as their financial advisor, how do you charge the client?
I charge the client as a percentage of the assets under management. And the chart shows there that you see there, ain't 1% on the first million. It's actually 1% on the first 500,000. And then it's less on the next layers and so forth in that way. So there's no fees. All my accounts are custodied at Schwab in the name of the individual. I'm just an invited guest to do the trading, and I'm allowed to debit the accounts for my fees. But other than that, I have no authority to send. So if you're kidnapped and held in a foreign country and I get a text that I have to send money out of your account, you're out of luck. I have no authority to do that.
And you do not sell any products or affiliated with anyone who does?
I do not sell any products, and I am not affiliated with anybody that does. My clients pay my fee, and there is no kickbacks or other incentives I get for any of the items that I am involved in.
Okay. I'm going to bypass your bio. It's there for people to read. So let's get right into the program.
Okay. It's Your Money. This is the topic today is fixed income investing as opposed to equity investing. Fixed income is also called bonds and anything that pays interest where your return is not based on price appreciation. So
Scott, you're the first person that we've had that is where we haven't talked about it, that being a NAPFA member. What does that mean?
National Association of Personal Financial Advisors is a group of people who advocate fee only fiduciary relationships. By fee only, that means the client pays the fees. There's no other source of revenue to me for selling product or indirectly for selling insurance or selling products where you're paying me a second time.
Okay.
Okay.
So NAPFA is a good place for consumers to go if they're seeking out a fee-only financial advisor.
That's right, Peter. And let me just finish with it, that also it's a fiduciary responsibility. We have fiduciary relationship with our clients, which means our clients come first. And part of that is you're not taking fees for any other products or anything else you're doing. The client is paying. And then on top of that, we always have to put the clients first in anything that we're recommending. There's no hidden agendas like you would find in a wirehouse or a standard brokerage arrangement.
And you put down there that your worldwide office is at Starbucks. Does that mean that you own a lot of Starbucks stock, or?
No, but I will meet my clients. Or in the last year and a half, I'm meeting clients online, but I meet most of my clients in a Starbucks. I don't have an office because most of my time is spent at Chapman, where I am an instructor in accounting. And so I don't have a formal office, and I just meet clients where, and that's usually the most convenient place to meet.
Okay, let's go to the next slide.
Okay, my partner, or actually my boss, is Julie Bray. She's my daughter. She has an investment management financial planning firm that she acquired. She went to work for them after spending 3.5 years at PIMCO and then 2 years with Brown Brothers Harriman in New York. She came back to California during the big 2008-2010 lash up, studied for her CFP, and while working for it, she worked for a local, one of the original financial planners and investment managers, fiduciary relationship oriented individuals here in Orange County. He built up his practice. She worked for him, and he decided he wanted to retire and said, "You want to buy the practice?" And I came in and we acquired it, and she runs it. And
Julie is great. And that's just not because she's your daughter. She's doing really well. Let's go to the next slide.
Okay. Now, what fundamental thing about, because people will say, well, taxes. All right. Yes, I do. And that's an important part. But I want to tell you that whenever you really get disgusted with the amount of taxes you're paying, particularly in California, just remember, thank goodness we don't get all the government we pay for. Will Rogers, the great comedian, said that.
I love that.
The second thing to remember about taxes is you don't let the tax tail wag the investment dog. Okay.
What does that mean?
Well, I'll get a client that'll come in and be salivating over the tax breaks on a proposed investment. Yes, but I can save this in tax, I can save that in tax. If you don't look at the fundamental economics of an investment, forget the taxes, look at the fundamental economics. Does it make sense? Does it give you a satisfactory return before tax? And then look at the tax breaks. Then you'll make a good decision. But if all you're looking at the tax breaks, you're going to get the greatest tax break of all. You're going to get to write off the whole investment when it fails as a tax. Okay, so investments, as I said, investments of any kind should make economic sense first, then consider the tax aspects. All right, now let's talk about investing. Investing is we're putting money at risk to gain a return, whether you do that in equities or you buy real estate or you buy an annuity, which I don't suggest. But all these things are all, you're making an investment when you're putting money out to get a return. And with that, you accept risk. And the risk really is the potential price change of a security up and down. And the ultimate risk, of course, is that the security fails. All right. So whenever you put money out at risk, you are investing, as opposed to speculating, where you're going for a quick return. Investments inevitably are long-term to be successful. Risks are driven by market risk. That means the various things that happen in the market. Credit risk, does the company have the ability to meet its financial obligations? And liquidity risk, can I quickly sell the investment with no loss of principal? But the fundamental thing to remember is risk drives return, not the other way around. You don't pick your return, you pick your risk. Next slide. The safe way to double your money is to fold it over once and put it in your pocket. So that's ultimately the safest risk, is the safest investment, excuse me, is not to do anything. And of course, that gives you no return, so you're no better off. In fact, you're worse off with inflation. So since I'm an accounting instructor, we're going to do some accounting today. And as I tell my students, you can run from accounting, but you cannot hide. Welcome to the Hotel California. You can leave anytime you like. Excuse me, you can quit anytime you like, but you can never leave, okay? So accounting is with us, so we need to understand a little bit about it, because that's what you're investing in. Now, assets, something of future economic value that the company or that you're investing in has. It has liabilities, and what's left over is your stockholders' equity. Now, liabilities are secured and unsecured creditor claims. So when we make an investment, we're going to invest in liabilities by buying bonds, or we're going to invest in stock and the equity. So that's where we're making an investment, in the liabilities and the stockholders' equity section of the balance sheet. Next slide. Okay, it's all right for you to try this at home. In fact, one of the things in my book, which I'll mention at the end, is to make a personalized balance sheet for yourself. What are your assets and what are your liabilities and what is your net worth? Because the object of financial planning is to increase your net worth. You do that by increasing assets and asset values and decreasing liabilities. Okay.
I was at when I was at the university at Long Beach State, I met with many professors, PhDs, MBAs, and they could not answer that simple question. They did not know how to put a net worth statement together. And it's sad, because many of them, when we sat down and did one, they were shocked at their own net worth, because they felt, being a university professor, that they weren't there to be rich, but between the medical insurance and the salaries and their savings, because if you become a university professor, you don't spend a lot. And so, but net worth is absolutely, totally important if you're going to do a financial plan.
Absolutely, because what is your goal? You want to increase your net worth. Now, rich people, what we call rich people, why are they rich? Because do they have a big salary each year? No, they're really rich because they have net worth. There are all kinds of people out there that have high salaries and no net worth. They look good, they have a flashy car and all the other things, live in a big house, but what you don't realize is that house is mortgaged up to the hilt for their lifestyle. So they don't have net worth. That's what the ultimate goal is, building net worth. Okay, and that means acquiring assets that are going to work for you and reducing liabilities that are working against you. Okay, on the next slide that you see there, what is fixed income? We know what equities are. I think you had that the last presentation.
Correct.
Equities are evidence of ownership. You own something. Fixed income is a loan to a company or a government in exchange for a promise to pay two things: interest each period, and the pay you back at maturity. Next slide. Okay, so what are the benefits of fixed income investing? Now, let me say you're going to have a portfolio of both equities and fixed income. This is not either or, you're going to have a mix. The benefits of fixed income: regular payments, reduced volatility because they're not actively traded. They're dependent on the interest rates in the market, which change but do so slowly. You have downside protection because you own the assets. If the company doesn't pay, you can seize the assets. And because it moves differently and responds differently to economic events, it's an offset. It diversifies you from your equity portfolio. So when I am investing my clients' money, I'm interested in equities and I'm interested in fixed income because they are going to complement each other, and there are benefits on both of them. So you're going to have a mix of both. Next slide. Okay, fixed income come in a bunch of securities, the different flavors, the 31 flavors of, there's all kinds of stuff out there. But there's some fundamental basics that you do need to know. The rest of it is, if you really get into the weeds, then you're going to want to understand the vocabulary. The next slide, please. All right. The first of all the flavors is the maturity date of the security, because the maturity date is going to be indicative of, giving an indication of the interest rate. The theory behind interest rates for fixed income securities is called the term structure of interest. The relationship between the market rate of interest and the maturity of the security that you see there on that graph. Now, this is called the yield curve. That's a plot on the left of the interest rate on the security and the length of time. And the yield curve is done for US government securities only, because it is the reference rate in the marketplace. US government securities are unique among all securities because they have no risk of default. Every other security in the fixed income security in the marketplace has a theoretical risk that the company sponsoring it or the entity, including government, state and local governments, have the ability to file bankruptcy. States can't, but we're going to test that. Anyway, the US government has no risk of default because they can just simply print money to pay you off. So the rate on US government securities, you see it there from 1 month all the way out to 30 years, is the reference rate in the market against which all securities are measured. So when you go into the market and you're looking at interest rates, they're all going to be in reference to the yield curve. That's the fundamental interest rate in the market. And that's the supply and demand for US government securities.
So, Scott, what does the US Treasury yield curve that you have on the screen tell us?
It tells us a couple of things. One is, if you look at it, that interest rates are slowly increasing over the last year. Okay, they've gone up in the last year. What's interesting is in the last month, they've stalled out and are starting to come down. So interest rates are expectations about the future value of money and inflation. So this is saying that inflation is slowly raising its head, but may be under control. Even though we're seeing prices go up, we're not seeing it in US government securities. Now, normally, if 2 or 3 years ago, that number was 5 or 6%. So we have been for the last 5, 6, 7 years in a very low interest rate environment, and that's absolutely unique. That we're almost down to the point where the government is paying, we're paying the government to hold securities. It's not quite there. It is that way in Japan. But in the US, we have very low interest rates. That's due to some of the work of the Fed, and it's also due to the fact of low expectations as to inflation. Now, on the curve there, the standard curve is closer to what's represented in the blue, which means that the longer you go out, the more interest you're going to want to hold that security as protection against inflation and future future monetary activity. So going from the lower left to the upper right would be the standard profile. Okay, sometimes these things reverse, and the lower rates on the left are higher than the longer rates on the right. We call that an inverted yield curve. And as economists like to point out, that's predicted 9 of the last 7 recessions. So this thing undulates is the best way to describe it. It's moving all the time as people seek out the shelter of owning U.S. government securities for an anticipation and as a hedge against future activities.
Let's go to the next slide.
More on the yield curve, plot of interest rates on U.S. government. Interest rates in the market are quoted relative to the U.S. government. I mentioned that. The riskless rate. There's no risk of default in theory from the U.S. government. The longer the maturity, that's why that line was rising from the left to the right, the greater the risk of inflation and default, the higher the interest rate demanded, right? If you have more risk with the money, you want a longer return. So the upward sloping curve from left to right on that graph is the normal one. As I mentioned, sometimes it'll flatten out, and sometimes it will even reverse, where you get the short-term rates being shorter than the long-term rates.
So if I were to read this, the longer the maturity, the greater the risk, the greater the risk of the bond.
The greater the risk, and the risk, don't forget interest rate risk. You buy the bond and it's 2.85% at the market rate of interest today. Well, if the market rate of interest, and we're going to bring this is going to come up on a slide, if the market rate of interest increases, you're going to see the value of the bond go down. That doesn't mean zero. You didn't lose your money, but we'll see that in a minute, what that relationship is.
Okay.
But the important thing is what Peter was trying to draw out is your reward, which is your interest rate, follows your risk. You end up going further and further out in the to maturity to get your interest rate, means you're taking on more and more risk. That the price of that bond will move around, even if there's no risk of default. And we call that chasing yield.
Yeah, I would
going out, and I see that with investors all the time, but I'm not making any money, so therefore I'm going to have to go out and buy a 30-year bond. Well, what you're going to see is you're going to be whipsawed in the market as interest rates change.
Yeah, the other thing too is that when people look at a mutual fund, a bond mutual fund, and they look at it and look at the yield on that bond fund, that yield was for the last year or for the previous year. Is that a good predictor of what the yield is going to be going forward?
Nobody can predict what the yield is going to be going forward. So what you see is what's called the current yield, which is, as Peter said, this is going to be the yield over the last year up to today. And so that is no prediction of the future. The closest you can come to of the future is the yield curve itself, which is what everybody's expectation is for the future. But as expectations change, that yield curve will change also. So you make your decision based on your information today. You can't wait for tomorrow to keep coming, otherwise you never invest. Now, further to the issue of what drives the price of a bond is who the issuer is. Banks and U.S. governments are going to have a little bit lower rates because there's less risk with a bank or a U.S. government. Foreign governments, you have your perception of the monetary policy of foreign governments. State and local municipalities, I do not buy for my accounts any California bonds, period, full stop. because the rates on California bonds completely discount the fact that at some point this state it's upside down right now. At some point it's got to fix itself, and when it does, it's going to screw the bondholders, because that's the only people they can screw. And then you have foreign and domestic corporations. So so bonds have all kinds of cross currents depending on who issued them, what was the purpose, what's the collateral, what is the risk of default. The only bond that can't default is U.S. government securities.
So when you say by security issue, when you're talking about banks issue CDs, that's a fixed income, correct?
That's right.
And so depending on the term of the CD and the maturity of the CD, I'm not sure if I'm using the correct terminology.
Right.
Yeah, you get a percentage or a yield return.
That's right. And if you notice, if you go on to bankrate.com, or if I go to the Navy Federal Credit Union and I'm looking at their CDs, which are short term, relatively short term, I notice they'll pay me a higher interest rate if I'm willing to put the money there longer. And that reflects I'm willing to take the risk. Now, I'm not worried about the Navy Federal Credit Union going under. What is the risk? The risk is that the market rate of interest will change, and I'm stuck with a CD that gets a below market rate of interest.
And we're going to talk about
always a trade-off.
Yeah.
There was a question about, are there any charitable vehicles that are issued that are fixed income sort of?
Not
charitable
that I'm aware
gift
of.
annuity.
Does the Salvation Army issue bonds?
No, they're talking about a charitable gift annuities that is a fixed income, but it's not
That's a totally different, that's not a security.
that's not a security. It's a
That's
gift.
an arrangement you have with an individual charity.
Exactly.
And that can't be traded. That's specific between you and the charity.
Yes. So the U.S. government, what kind of fixed income instruments does the U.S. government provide?
Everything from 1 month to 30 years.
So they have, I don't know if we're going to go into this. Are you going to go into the different types, U.S. Treasuries, tips, and et cetera?
No, not too much, because basically, I don't deal in any individual bonds from anybody, even the U.S. government. I prefer to invest using bond funds for the diversification. Now, you've all heard of mutual funds for stocks. Well, they exist for bonds. And the beauty of them is you are buying a basket of bonds. All right. And they have an average maturity and another characteristic called duration, which we'll talk about in a minute. But the point is, inside this basket, the bonds are constantly turning over. They're maturing, or they're being sold by the bond manager to provide a rate of return to the mutual fund holder. So so a lot of the vocabulary of bonds, you don't need to know necessarily, because you're relying on the bond manager who owns this big basket of bonds to pay attention to those details. You should never buy individual bonds unless you're positively super wealthy. Okay, so because bonds are sold differently than stocks. Stocks are on an organized exchange. You put your order in, it goes to an exchange where everybody sees the price, and whoever wants to sell you the stocks is going to step forward, and everybody sees what the market price is.
Yeah,
That's not the case with bonds.
Yeah, if anybody
Think of
wants,
bonds as selling on Craigslist,
yeah,
where you got to go looking for it. And so there's a terminology called the spread between the price that somebody's willing to buy and somebody's willing to sell. And if bonds aren't actively traded, that spread will increase. And if bonds are actively traded, that spread will decrease. Well, guess what? How does your broker who's looking for this bond, do they want one where there's a narrow spread, or one that has a wider spread? They want the wider spread, because then they can take parts of that as commission.
yeah.
So you can't compete with the big guys.
No, you can't. And if you really want to know what goes on in the bond industry, recommend highly the book from Michael Lewis, Liar's Poker. It's been around for a long time, but you can get an idea of what selling bonds are all about. How about foreign bonds, Scott?
Why?
Would you diversify into foreign bonds at this present time?
U.S. companies are around the world. So if I have a mutual fund that has bonds issued from Coca-Cola, have I got exposure to foreign bonds?
Yes,
I do. All right. Now the problem with if I went over and bought a bond that was all English pounds or denominated in another currency, I have added another complication, which is currency risk. All right, the relationship between the dollar and the British pound will change over time, which will impact my rate of return.
yes.
So why would I go overseas?
Yeah,
I can get foreign exposure, which is good. I mean, we should be participants in the market, and with the large U.S. domestic companies that I can invest in.
Yeah.
Do you think you're not getting foreign exposure if you bought Facebook stock?
You are.
Okay, you are. Google. There's no
Yeah.
foreign exposure in Google?
Yeah.
Right. Okay.
Yes. Don't go up yet. Talk a little bit about people. We said don't let the tax tail wag the investment dog. People love municipal bonds. And municipal bonds, talk a little bit about the advantages and disadvantages of municipal bonds.
Well, the theory behind municipal bonds is that because of the federal government can't tax states and the states can't tax the federal government, interest paid by a state bond is typically tax exempt from federal taxes, and they can also, in the state where you're a citizen, if you're paying tax, say in California, will also be exempt from California tax. And so I'll get people that'll salivate. I'm not paying taxes. Do you want great? We got a governor here who's going to be recalled again. Gavin Newsom, who's up for recall. Okay. Do you want your retirement dependent on what happens in Sacramento?
So when you look at a municipal bond, you should look at the idea that your after-tax return on a corporate bond is either higher or lower. In other words, look at the yield for both after taxes.
Yes, you would adjust the domestic bond, the company bond, for the amount of taxes you're paying, and compare that rate with what's being offered by the municipal bond. Because in theory, since you don't have to pay taxes, they can issue their securities, the municipality can issue their securities with a lower interest rate because it's not going to be taxed. So people say, oh, wow, I'm not being taxed. And they never make that comparison.
You guys, there's a question. There's a question. And it's a simple question. You may be answered later when you get into prices of bonds and how they change. But where does your profit come from bond funds?
You're interested in bond funds because they pay you interest.
And
No. At our level, we are not interested in trading bonds. We will buy and hold them. So if you buy an individual bond or you buy a mutual fund of bonds, you are sitting there and your interest is in the income you're getting. That's why it's called fixed income. Now, with a basket of bonds, as the market rates of interest change and the bonds turn over in that basket, you're going to continue to follow the interest rates in the market. If market interest rates go up over the next couple of years, you're going to see that your bond fund is paying more and more interest as bonds mature. They invest in securities that pay the higher interest rate. So you're investing in bonds because you want the interest income there, and you're not counting on appreciation. Although the bond manager may be buying and selling bonds, and you may see some gains off of that. That's not why you're investing in fixed income. You want the income as the primary reason for your investment. For equities, your primary reason for investing in equities is that they are appreciating in price. That's your long-term goal, is appreciation, and to be paid in the meantime with dividends. Okay, that's a different return than fixed income.
So
that's why you want both of them in your portfolio, because they're doing different things.
So Scott, in your client's portfolio, I am assuming that the bulk of your fixed income investing is in corporate bond funds.
That is correct.
Okay.
And because the reason I don't do municipal bond funds and state bond funds is because the funds that pay the highest yields are also the riskiest. As I indicated, at some point in California's life, we're going to end up with a big adjustment, and I don't want my stockholders holding California bonds only. And for all those years that they thought they were getting a tax break, only to come back and haunt me because the bonds, for whatever reason, and maybe the California just stops paying interest on the bonds. They can do that, and there's nothing you can do about it.
Let's go to types of securities.
Okay, there's all kinds. Remember, there's all kinds of words in the bond business. Secured means there's collateral. Unsecured means there's no collateral. If a bond that is secured, which would be most of the bonds that I deal with, have a security in that the assets of the corporation are pledged to pay the bond. Bond may be convertible, which means it's convertible into common stock at some price set forth in the indenture. It's callable, which means you see these more with municipal bonds than you do with corporate bonds. Callable means that the issuer has the right to force you to redeem the bond. That's because they may have a high interest rate coupon, and they want to replace it with a lower interest rate coupon as the market declines. So they'll call the bonds and pay it off with a lower rate coupon. That's smart on their part, but you don't have that high interest rate that you were getting before. Zero coupon bonds are a special type of bond that don't pay interest. Everything comes at maturity. And those are, insurance company loves those because each year they know they have a certain number of claims and they want their bonds maturing in those years so they have the ready cash. Strips are just the reverse. Strips are bonds that only pay interest, and in the process of that include the principal, so that there's nothing at maturity. They've paid you off over the life. Think of that as an annuity. They've paid you off over the life of the bond, and at the end, the contract is over.
99% of the listening audience, all these types of securities are of no interest. You don't need to know them because you're going to be investing in a bond mutual fund. Let's go to the next slide.
Okay, now another more of the flavors are the credit ratings of the bonds. Now notice that there are 4 ratings at the top: AAA, AA, single A, and triple B. There are only 2 or 3 companies now that are actually AAA. Most of the time you see the US government's AAA because it is the prime, the best, which means notice that the interest rate moves in inverse proportion to the risk of the bond. The bonds that have the least risk, which are considered prime, have the lowest rate. And then the rating agencies, and I've listed 2 of them here. There's 1 or 2 others. The triple Bs are considered investment grade. Everything below that is not investment grade. In other words, the chances are that at some point there's going to be a hiccup. BB, B, triple C, all the way down to D, which is dead on arrival. Okay, so when you look at your bond fund, you want to look at the average credit rating, and you want it to be, in theory, AAA, AA, single A, BBB. Most of my funds are either A, average rating of A, or average rating of triple B. I don't get down into anything down into the non-investment grades. And so far, I haven't had a problem.
Yeah. And this is really important to know about the bond mutual fund that you own. What is their total portfolio of bonds, credit rating of that bond fund?
Because
Somebody,
remember, that's right. And what Peter is emphasizing is, remember, return follows risk. You pick your risk, not your return.
right.
So you may not like the interest rates you're getting on triple, even down to triple Bs, but remember, you pick the risk first and then you get the return. Because I can guarantee you that if you pick the return first, you will pick something down in the C and the D category because it has a fabulous return.
Yeah. And the nomenclature is high yield bond funds probably are referring to what, Scott?
Well, that's a marketing term to get you to buy something down in the double B, single B area.
Yeah.
They also are called junk bonds.
Yes.
Okay, where there's a perceptive risk of default. So high yield is a marketing term because remember, you don't pick your reward, you pick your risk. And when they say high yield, what are they getting you to focus on? Reward, not risk.
Yes.
Okay, and the risks on the slides that follow are some of the risks. We have two types of risks. We have interest rate risk, that interest rates are going to change. And we have inflation risk, the decline in the purchasing power of the fixed income, because if we're going to tie up our money, that means that money sits there even for a year or 2 years or 5 years. And the purchasing power of that dollar that you've invested in a bond is slowly declining because of inflation. So those are our two primary risks, interest rate risk. Next slide. Okay, let's talk about interest rate risk. And this is really important to understand the relationship. Interest rates and the value of a security move in opposite directions. We call this the teeter-totter effect. And it's important that you understand that, so you understand that when the price of a bond goes down, for example, it doesn't mean that its quality has gone down. It just reflects the fact that the interest rate is changing. Next slide. Okay, now think about here. I got two illustrations here. I want to have $1,000. I'm going to my $1,000 back in 5 years. If I have a choice, I can put aside today $783.54 that earns 5% to reach my $1,000 goal. Or I can put away money that I can put away $620.93 that's going to earn 10%. Either one of those will reach my goal. So you see, the price today is inversely proportional to the interest rate. Okay, so the higher the interest rate, the less I have to put away for the future. Okay. So the important thing to remember, though, is that the price of bonds do change, and they change because of the interest rate, which is the cost of money, changes all the time by all the influences in the market. Okay, and since bond prices change, I can have gains or losses in my bond if I'm a bond fund manager that may be attractive. But if I bought individual bonds, I'm holding them to the maturity, because what I really want, if I want to trade bonds, I'm better off trading stocks. So I buy bonds for my portfolio because I'm interested in the interest rate that is being generated as an offset to the equities, the characteristics of the stock, the equities in my portfolio. Next slide. Duration. Now, here's an important concept that is really, it's almost upside down. The duration is a bond's measure of sensitivity to interest rate changes. It's a complex math formula you don't need to worry about. It's more important than time to maturity, because this talks about how the bond behaves because that tells you how sensitive the price changes may be to interest rate changes. The less, the fewer, and it's for whatever reason, it's expressed in years. So bond duration, the shorter the bond duration, the less sensitive it is to interest rate changes. So the furthest I go out is 5 years, and even then, some of my holdings, some of my funds have less than that, and I like, because I believe interest rates are going to go up at some point. And I'm not worried that I call it correctly, because I know that over time, my basket of funds, my basket of bonds, as they mature, will be replaced with bonds at the market rate of interest. So my bond fund interest rate is going to change with time as interest rates go up or down. As bonds mature, they will be reinvested. But the duration gives me some idea of how this portfolio is going to respond to interest rates. And so when I'm looking at my mutual funds, I want to keep it at about 5 years or less, so that as interest rates change, that works into my portfolio relatively quickly.
So
now we know from the yield curve, the pattern of the yield curve, the longer I go out, the higher the interest rate. So there's a trade-off in there of how far do you want to go out for the sensitivity to the change. And I picked, my rule of thumb is roughly 5 years or less.
okay, so this is the second most important thing I think that we've come to in your presentation, and that is individuals need to look at their own bond portfolio, mutual funds that they own at the present time. One, look at the credit rating of that fund as a whole, and two, what is the duration, the average duration in that fund? And what you're saying is that if it's over 5 years, take another look, because you're taking a major risk.
You're taking a risk that your bond will respond too slowly to changes in interest rates.
Okay.
Now, we didn't say anything about default or anything else like that. This has nothing to do with default or risk, or it just says how fast is your fund going to respond to changes in interest rates?
Correct.
Now, clearly, if I had a duration of 1 year, it's going to respond very quickly, but what's the interest rate I'm going to get on a 1-year security? It's very low.
Less than 1%, probably.
Less than 1%. So
Yeah.
this thing is, so it's.
What is the average? What is the average corporate bond portfolio for your clients? What kind of yields are you looking at or projecting in that portfolio?
I can get 3 or 4% yields with a 5-year duration.
Okay.
So I'm happy with that. You know,
yeah.
Remember, these are all trade-offs, and it doesn't stand still.
Well,
and
it's
there's
better
no right and wrong.
in the 3-5% range. That is certainly better than a CD. Let's go to the next slide.
Okay. Inflation risk is the second risk. Remember, the first one is interest rate risk, that interest rates will change. And the second risk that you have is inflation. Because remember, you're not buying to make a gain or loss on the sale of bonds. You're buying because you want the interest rate. And so you've tied up your money. In the meantime, the value of that money is declining, whether you have it in your mattress or you have it in a bond fund. Next slide. Okay, Yogi Berra, a nickel ain't worth a dime anymore, one of his many sayings. Here's an illustration. Between 1980, when the postage was 15 cents, and 2021, when the postage was 55 cents, that indicates postal inflation anyway is 3.2% a year. Now, the US Department of Labor price index calculator was 1,000 in January of 1980, and it was worth 34.33 in April of 2021 as I prepared these slides. And if I calculate it out, it turns out that that's an inflation rate of 3% over all that time. Okay, now the US Department of Labor Consumer Price Index is on the web, and that's where I get the information. So from that, we draw two conclusions. One is living on a portfolio of all fixed income, in other words, no equities, all fixed income, is a great way to outlive the value of your portfolio. In other words, it simply won't buy what it used to. And the second thing is, don't even think about USC tuition. All right, what's happening with that?
It's hard to imagine. It really came home to me when my son came down and we went to the theater when we could go to the theater. And I was expecting to pay for a movie $3 to $5, and it was $12. And I said, my God. And my
that's with
son
the
said,
senior
"Well,
citizen discount.
yeah, exactly. To him, it was, that's the price of a movie, Dad. What are you worried about?"
That's right. Okay, now your strategies with fixed income is use bond funds, as Peter and I have both said, not ETFs and not exchange traded notes. Stay away from the exotic. Okay. Investing, long-term investing is boring. I remind my clients that if they want something exciting, go to Las Vegas. But if they're coming to me with their retirement funds, I better be the most boring person they're talking to. You have some idea of the yield curve. I mean, you can see that in the Wall Street Journal. It's available at occasional places on the web. Just kind of periodically check it. What does the yield curve look like? What is it saying to us? Remember that risk, time to maturity, is a trade-off to return. All right. You want to pick your risk and you get your return. If you pick your return, I can guarantee you the return you want comes with a lot of risk. Check the overall credit quality of the bonds held in the fund. They will tell you the average quality. Morningstar is a free service. You can go on Morningstar and enter the bond fund you're interested in, and it'll give you some of the statistics. And duration is an important metric because it's we live in an inflationary environment. I mean, we can see it, even if it's not in the government statistics yet. So it's important that you pick bond funds that are going to respond gradually, but will respond to changes in interest rates, which reflect expectations of inflation.
Because the bond area, the fixed income area pays, or the expectation is the return is so much lower than the equity side of the market, it becomes really important to look at expenses of a mutual fund. And so in the bond area, controlling expenses is almost number one in order to eke out a little bit of more yield. So if you're going to do this on your own, I would highly recommend sticking with Vanguard mutual funds for your bond portfolio.
I would absolutely agree. Remember, there's only a market rate of return. And the more people that take a slice of that market rate of return, the less is for you. So Vanguard's a good company. There are a couple of other good companies out there. We call them families of funds. Most of my holdings are in Vanguard. The second company that I have a lot of money with is PIMCO. They tend to be a little more expensive, but the returns tend to be higher, and while controlling for risk. So when your broker calls up and he's got something exotic, the answer is, I'm going to change my broker.
Good answer. Let's go to the next slide.
Okay, now be wary of individual bonds. So we're talking about strategies. We want to focus on bond funds, and some of these points I made earlier. They're not traded on organized exchanges, so you're up against the big guys. And as we used to say in Vietnam, when the water buffalo fight, the grass gets trampled. So who's the guy that's going to get screwed on pricing? It's going to be the small guy. So stick with bond funds. They're subject to wide price variations, and you don't know how to play that game.
And why do you think that the index funds are not a good idea, or ETFs are a good idea in the bond area? This
is a theoretical issue that many of us are uncomfortable with. In the stock area, an ETF, which is a basket of, okay, let me back up. An ETF is a mutual fund that trades during the day. A mutual fund takes all the trades and settles at the end of the day. An ETF gives you a price during the day. So that's the big difference excuse me, between an ETF and a bond fund. An ETF also follows a specific strategy, such as an index. So I like ETFs for equities because the information that's in the marketplace regarding equities is known by all immediately. So the price of the ETF immediately reflects all the stocks in the portfolio it holds. Bonds, on the other hand, that market is not as transparent as the stock market because there's no organized exchange where you can go and check to see what the price is, and you have the variations among the bonds for maturity, for quality, for all the various things we've listed up above. So an ETF, which is a price at any point during the day, can differ if I knew perfectly what the price of all the other individual bonds were, but I don't. So there's a theoretical difference between the ETF and the price of the underlying bonds.
There's a question. So just are there bond index funds or bond index mutual funds, kind of like stock index funds?
They are, and they attempt to follow some of the bond indexes. But the bond index, even the indexes themselves, are baskets of bonds that are constantly changing. Okay. So a bond index is not as indicative of where things are as a stock index, where you know the price of the individual stocks in the index at any point in time.
Let's go to the next slide.
You got to know your territory. So when you're buying and selling bonds, you got to know what you're doing. That's why, again, I encourage you to stick with bond funds. Next slide.
This is the most complicated area. How big is the bond market, by the way, compared to the equity market?
It is 3 or 4 times the size of the equity market. It is huge. And so when the president, and this is a standing, when the president is more afraid of the bond market than the stock market, because the bond market is so large and affects so many things, okay? Because interest rates affect so many things. Now, just like we said that bond prices move inversely for interest rates, what is a loan to buy a house? That's a fixed income security to a bank. So the price is going to vary inversely with interest rates. One of the reasons we have such high prices for homes right now is because the cost of borrowing money is so cheap. If we start to see interest rates rise, we will see the prices stabilize and maybe even go down, because the cost of the money to borrow money to buy the house dramatically influences how much house you can buy. So if you're a seller, you have to respond to the fact that as interest rates go up, people can't borrow enough money to make your price, so you lower your price. So the president is more afraid of the bond market than he is of the stock market. There's a great quote from one of President Clinton's advisors that if he used to think that when he died, he wanted to come back as a 400, as a baseball player that had a 400 batting average. And he said after he served in the Clinton administration, he came back. He said, "No, when I die, I want to come back as the bond market because I can scare the hell out of everyone." So anyway,
market descriptor.
More terms for buying and selling. Yes. And you can see there is a huge vocabulary in here to know and to check. And there's nothing really that you can say, oh, that's the thing that you want to follow, because you want to be aware of all the stuff going on in the markets, because you're comparing bonds of different companies, different qualities, different maturities. They have a call, they don't have a call. What is their duration? What is their premium? A premium and discount just means is the price above or below its par value. It has nothing to do with their Kmart special, that this is a better bond or a worse bond. It's just whether the price is higher than its maturity value or lower. Now, all bonds at the end are going to rise up to their maturity value. And so you also have that trend going forward. And you have the bid and the ask and the spread. So you do not want to be dealing with individual bonds. If your broker is selling you individual bonds, it's time to change brokers.
We have an article on the website in the material on buying a bond fund versus buying individual bonds. So you could read that as well on your own. Let's go to the next slide.
All right, why do you have fixed income in your portfolio? Because you need both. Remember, you need equity and you need bond funds. Bond funds provide a regular payment stream because they pay interest as part of the deal. A stock does not have to pay a dividend, and even if it's paying a dividend, it doesn't have to increase it or even continue it. Bonds have reduced volatility because they respond to changes in the interest rate. So there'll be a slow undulation, but they won't see the wide swings that you have in equities. You have the downside protection of the fact that the bonds that you're going to be dealing with in any kind of portfolio that's investment grade will be secured by assets of the corporation. So the bond holders can seize the assets of the corporation to pay the bond. And you have the diversification to offset the things that you have in the equity market with the different characteristics of the fixed income market.
Yeah. So if you're stopped working and you need income for the rest of your life, then you have a percentage of your portfolio in the fixed income area. If you have, I'm going to put in a wild example here. Let's say you have $100 million and you have plenty of income. You have no concern whatsoever. And, you can literally hide the $100 million in a bank or US treasuries, because if you don't want to, if your goal is not to expand your portfolio, you want zero amount of risk. So you can do it in US treasuries or diversification. The bottom line is that what is your goal? What is your circumstances? How much, I think, Scott, you put it so well. What is your risk? Instead of looking at the yield, because that bond portfolio reduces the volatility. And people hate that up and down. Hey, 1 year my portfolio value is X, next year it's Y. You want it to stay somewhat steady throughout the rest of your life. You don't want it to jump up and down.
There's a question someone's asking. I don't know if you've heard of the, like, what about buying e-bonds? Like, maybe they're talking about the grade. I don't know, but I've never heard of this.
I've never heard of it either. So that's the first thing you don't, the answer is no.
I've never heard of an e-bond either.
All right.
Remember, the financial services industry is about selling stuff, okay? And this stuff is complicated. So if I can tell you this bond, whether it's an e-bond or an X bond or whatever, and it's so wonderful and it'll give you blah, 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 I'm trying to sell you something that they think you will fall for.
I think she just clarified it's her e-bond's a savings bond.
Oh, the e-savings bond. Okay. All right. They savings bonds are great to give them to their kids, but they're not really, you're investing in a US government security, which pays a lower interest rate than comparable corporates. So if as a present to your grandkids, yes, maybe, because they're
give them a stock.
Well, yeah, that's what I do. I have accounts for each one of my grandkids, and periodically I just buy something and stick it in there.
Yeah.
And they're 100. Now, here's a little chart to give you an idea of what should be fixed income, what your fixed income percentage should be. And notice that under age 50, I normally start at 60% of equity, so 40% fixed income. So it gives you an idea of what it might be. So even somebody who was 90 years old that came to me it's still going to be 20% of their portfolio is going to be equities. Why? Because it's the only way I can offset the effects of inflation is to have part of their portfolio appreciating over time with the market. Now, the market does not grow to the sky, as many people on Reddit are suddenly discovering with all the crazy stuff going on over there. Okay, so the market stocks don't go to the sky, but they're going to appreciate and offset the fact that you're losing value, purchasing power value in bonds. But you got to have both of them.
Yeah. And by the way, the chart it's a rule of thumb.
It's a rule of thumb.
You know, it depends on your individual portfolio. What kind of income do you have? What kind of risk can you tolerate? What are your goals to spend money? Or, you know, if your goal is to buy a 747, you might have to do something different. So it's all of this is very generic.
I'm getting bombarded with questions. So
good.
Okay. We're 32. I can do the questions now. Okay. So how does the interest income affect your taxes?
Well, you pay taxes on interest income and you pay taxes on dividends. You pay taxes on everything. And one of the earlier slides was don't let the tax tail wag the investment dog. You want to look for the economic return first before you worry about the tax effect. If you have no income, you have no taxes. Isn't that the best solution if you want to avoid taxes? I don't think so. Okay. So don't let the tax tail wag the investment dog. You want to make sure that you've got your investments picked carefully for the economics of them and what you understand about them, and then pay the taxes. Unless you want to move to Tennessee or Texas, you're going to pay taxes. And even then you got to pay federal taxes.
And I like the word that you used, consider it. Don't rely totally on it, because capital gains income is taxed at a more favorable rate than ordinary income.
Yeah. There's another question. Would you consider historically increasing dividend paying stocks as a form of fixed income?
Well, to get the diversification necessary, you need 30 or 40 of the stocks. That's why I have 2 dividend paying ETFs, and my general mix of my accounts is half of the equities are in 2 or 3 dividend focused ETFs, but half the equities are in the S&P 500 index. So I'm a little bit I'm more towards, I like being paid for my investments. I like my clients to get money back. So I get dividends and those and the beta of the dividend funds, which means how fast do they move compared to the regular market, is about 0.9. So they move about 90% as fast because I'm getting a little more cash out of them than the market, but half my equity positions are in the S&P 500 fund. Now, do I invest in individual stocks? A little bit. Everybody needs a little mad money where, and I don't mean a long shot, 40 to 1 odds. I'll have a little bit of Amazon, a little bit of Microsoft, a little bit of Apple, but it's under 5% in the portfolio. I'm not dependent on them. It's just nice because they're kind of interesting stocks. I don't go with Google, I don't go with Facebook, and I don't go with Netflix. And those are the ones that are always those 6 are usually the ones that are making most of the news. And people kind of feel, hey, I've got some of that. So I call that my mad money. But by and large, it's 60% dividend ETFs and index ETFs and 40% bond funds.
Scott, focus a little bit on your number 3 there, the portfolio design. What does that mean? Acceptable time to recover from an unfavorable price change?
Okay, if occasionally we have slumps in the market. I'm not talking about March of last year when it went down and it came back pretty quickly. I'm talking about some sort of reversal like 9/11, where the market sells off and takes 2 or 3 years to come back. Now, if you're 40, that's a blip. If you're 60, that's a significant part of your time. So one of the reasons for where is my split between equities and fixed income is I can't stand the volatility, too much volatility in the equity portion. So I want to have my fixed income to carry me through those periods when the market has sold off and it's going to be 2 or 3 years to recover. Like I said, when I'm 60, that's a lot more of the time of my horizon than when I'm 30 or 40.
So you don't want to be forced to sell your equity
I
portfolio.
don't want to be forced to sell. That's right.
Yeah. And that's one of the reasons why you have a fixed income portion of your portfolio. So you could live off the fixed income portion and not have to sell the equity, because over time, equities outperform fixed income.
They outperform, but it's not really a fair thing, because equities are moving in a different direction. They appreciate. We're not buying fixed income for appreciation.
Exactly.
We're buying fixed income for the interest we're getting. And remember, you'll notice what I said, dividend funds. With virtually everything I do, I want some return. All right. Amazon doesn't pay a dividend, but that's in my mad money. All right. So I want return. And I'm like Warren Buffett. Warren Buffett wants return.
Next slide.
Go ahead, next slide, please. Let's finish out. Okay. And Peter picked this up. Now, we talked a lot about things, but they're not rules. As in the Pirates Code, they're more like guidelines. If you remember that line from the movie, it was great. After tatting the Pirates Code all the movie, they finally say, no. It's just guidelines. It really isn't that strong. So we've given you guidelines here. And one of the biggest things I want to, one of the other great marketing shticks out there is this idea that we can give you a test to measure your risk. That is marketing. Because when the market goes down, everybody wants to sell. So there are people that say, oh, I can take a lot of equity risk. And so they load up the portfolio, a lot of risky stocks. Well, what happens when those go down? Boy, do they come after the broker, pitchforks and torches.
Let's go to the next slide.
Don't go buying this that we're going to match you to your risk. I don't want to be a part of anything that's going to risk my money, period. Don't tell me that you can control risk. Just think about 2009, 2010, and what happened to the market then. Okay, there are a lot of people that came unglued over that. With my clients, nobody sold because we knew this. I kept saying, this too shall pass. And that's exactly what happened. I had one client who demanded that I go to cash because his neighbor had said the world was ending. He went to cash. I finally got him back in the market. When did he go to cash? At the very bottom. And it took me 6 months to get him back in the market. He lost about $100,000. Okay. Warren Buffett, as you see on the screen, our favorite holding period is forever. Now, Warren Buffett has made mistakes. If you read his letters to the stockholders, not every other year, he'll admit to some big mistake. And inevitably, it's something like, I don't know what I was thinking at the time. All right. So even Warren Buffett makes mistakes. And buys things that he looks back and says, what was I doing? Yeah. So that's why I like index funds. I like the mutual funds because I have a I have a diversified position with no one position is going to take me down.
Diversification.
Experience has taught me a few things. One is to listen to your gut, no matter how good things look on paper. The second is that you're generally better off sticking to what you know. In other words, if you can understand it, it makes sense. And the third is sometimes your best investments are the ones you don't make.
Wow.
Okay.
I love that one.
There was a question on one of your slides, and it was sorry, I'm trying to find it. What is it says $4 annual withdrawal postulate. What does,
Okay, the 4%, in
4%.
financial planning, a guy by the name of Bengen wrote a paper, a decade ago. Then he went back and the question for a financial planner is always, how much can I withdraw from a portfolio so I don't outlive my portfolio? So he went back and he looked at a 60-40, 60% equity, 40% US government security portfolio. And he looked at various different things, and he came up and back tested them against the historic returns in the market with a probability of somebody lasting 30 years so that they have money at the end of the 30 years. Presumably by that time, it goes to the heirs. And he concluded that about a 4% withdrawal postulate. So you could withdraw 4% of your portfolio each year, adjusted for inflation, in a 60% equity, 40% fixed income. And that was probably the most likely scenario in which you would not outlive your money. In other words, it had the lowest probability that you would run out of cash if you lived out the 30 years. And that has been the guiding star for a lot of the research. And of course, with that, having set that as the target, people are testing various things around it. What happens if this happens? What happens to that? But it still comes around to 4 or 5% of your portfolio a year, if it's roughly, notice, more equities than fixed income. And you would not, and your portfolio would outlive you, which is what you essentially want. In other words, you don't want to die with no cash in the bank. That's no goal.
Really? Right? I thought I wanted to have my last check bounce.
That in theory, and it would be easy for if the thing that's missing from financial planning, when you sit down with a financial planner, the thing you have to provide them with is your date of death.
Yes.
Okay. If you can tell us what your date of death is, boy, can I design some stuff for you.
Yeah.
But the answer is we can't.
That's where the 4% annual withdrawal came from.
It's a rough rule. Remember, it's the Pirates Code. It's guidelines.
Yes. It's a guideline. It's a guideline. Let's go to the, Scott has written a book, and it's probably one of the best books I have read on fixed income, budgeting, net worth, calculating. It actually is interesting. So compliment you, Scott, for doing this. Oh, you revised the edition.
You can get the old one. Just know that the rules on Social Security and some of the tax stuff has changed, but the financial planning stuff hasn't changed. And there's a little, and there's in there, it gives you a sample of a balance sheet, doing a personal balance sheet. There's 2 exercises in chapter 1 that have absolutely stood the test of time. One is a spending review where you track your spending. Notice I didn't say the word budget. A budget is a license to beat somebody. We talk about it as a spending review. In corporate world, licenses, a budget is something to beat somebody with. And the second one is to do a personal balance sheet and come up with your net worth. So you can see, as you make decisions, you have a reference point for the decisions you're making. And when you have a balance sheet, you take the assets equals liabilities plus your net worth. So we increase our net worth by investing in assets that will grow, stocks, real estate, and bonds, because they give us income return. And then we want to minimize liabilities, which means paying down debt. Part of the plan, and that's a trade-off. Again, a lot of the stuff is a trade-off. There is no right answer. But one thing's for sure, you want to have no debt. Read zero, Z-E-R-O, debt, when you go to retirement. And if that means you have to work until you're 75, you work until you're 75, because you don't want to take your retirement income to pay your rent.
And one of the things that we don't talk about much in our workshops is the reverse mortgage industry. and reverse mortgages are debt. Now, for some individuals that absolutely have no other choice except for the equity in their home, thankfully, a reverse mortgage is there. But don't be swayed by drinking margaritas in the Bahamas, and a reverse mortgage is what going to get you there, because that literally is debt.
What you see on the marketing, on the commercials, where the people, like he said, enjoying the drink in the Caribbean, if that's why you took out a reverse mortgage, guess what? You better be planning to check out sooner rather than later, because it isn't going to last.
Yeah.
You'd be surprised. The earlier you take it, goes like this.
Yeah,
Sound familiar? Look familiar? In other words, if interest rates are low, I can get more money from my reverse mortgage. But then how many years am I going to live off that mortgage? And if you think you're going to get it at 62, which is the first year you can qualify, it's not going to be anything worth writing home about. And that's all you get. You don't, and unless you have inflation and come back and refi and start getting more complicated stuff. Peter described it. It's I'm glad it's there, but it's the last resort.
Last resort. And the other thing too is that remember that spending is sometimes difficult as you get older. So, and we forget about your net worth. Give you an example. I had a 94-year-old call me, and she had $300,000 in the bank. And she was wondering whether or not that it would be okay for her to give $10,000 to her 3 grandkids, $10,000 each. And she really wanted to help them with their college education. And she was afraid to spend it, thinking that she may need it. And so we started going through a little bit of what she owned, and she forgot the value of her house as part of her net worth. She forgot about her insurance that she had as part of her net worth. I asked her, I said, do you save any part of your income? And she said, yes. I said, then what is the problem with you gifting $10,000 each to your grandchildren? She says, I just needed to be reassured. I'm afraid of that the $300,000 was her security. So it's sometimes difficult to spend. And, and net worth, you said it best. That's where your focus ought to be. And every year you should look at your net worth at least once a year. Would you recommend that, Scott?
Absolutely. I do it each year. After I've done my taxes, I update it. And I update it for 2 reasons. One, because I want to know. But the second thing is, and this is another thing, that gives me a list of assets and liabilities that if something happened to me, my wife is going to have to attend to. Or whoever is going to be, probably one of my daughters is probably going to step in and do it. But that gives me a clear indication to whoever has to clear up my estate of what exists where. So I take so it's both a calculation, gives me the net worth, but it's also a list of all the rocks they need to pick up when I'm not here, and to look for. And so it's very helpful. And for one spouse is particularly money oriented and the other spouse isn't, it gives them the reassurance that, oh, okay, I know what I have to look at because here's all the things. So it does a number of different, it's not just about money. It's about helping protect people, your spouse, your partner, whomever.
Yeah, I want to just follow up on that, because upon deaths are public records. And so you are going to get, the surviving spouse is going to get a lot of calls. Not only are you going to get a lot of calls from outside brokers, salespeople, etc., but you're also going to get family members who are going to tell the spouse exactly what to do. And they may not have any better knowledge than you. So make sure that that the surviving spouse, that you have some sort of a plan, that you may go to a fee-only fiduciary advisor if the person who handled the money is dies. There is no sin in not knowing about money. Money is boring. It's a lot more fun to enjoy the money if you have somebody who has a fiduciary best interest relationship to you that you can trust. And it's one of the greatest gifts that you can give your spouse or your partner.
Awesome. Well, that was very, very rich and deep, and this will be recorded. Scott, thank you so much for all your information, because you obviously know your stuff. So, and you can tell there's a lifetime of knowledge there. Next week, Pete, what are we doing? We'll be this will be the last series or the last session next week. We're going into kind of more of a behavioral finances, sort of what they call it. But what can you explain a little more about what that means?
It means that it's more along the lines of the Daniel Kahneman, that our mind sometimes pulls tricks on us. That why is it difficult for people to save? Why do we make certain decisions that we do? And it's also going to be part just a general review of asset allocation, of diversification, and why those things are important.
Great. All right. Well, thank you very much. And also, we'll see you next week for It's Your Money. And then tomorrow, we have week 7 of It's Your Estate at 10 o'clock. So we'll see many of you there.
Just a quick one, just to answer the question. Julie Bray is Scott's daughter, who is a CFP, worked for PIMCO, has her own financial planning fiduciary practice here in Costa Mesa. And she's on, her information is at the front of the outline if you want to touch base with her. All right, Scott, thank you so much. Trevor, thank you. Everybody who participated, really appreciate it. We'll hopefully see you next week or maybe tomorrow. Take care.
All right.
Take care.